The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
3 witches, 2 rate cuts, and 1 big fat government shutdown. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex. I like what you did there.
Thank you. Ho, ho, ho.
That was really good. See, I was going more for like a Freaky Friday situation because the S&P is now up almost a whopping 1.5%. Now, if you look at where the futures were about 7 o'clock in the morning, the situation was looking very, very grim. And at 8:30 CPI, the PCE data started to turn that around. But then we've been rocketing higher ever since 10 a.m. this morning, whether you're looking at the NASDAQ, the Russell, mid-caps, S&P, 5-year yield, also lots of buying in the belly, Romaine, and the VIX moving down a little bit despite that big spike we saw earlier in the week.
Yeah, and a big spike in volume here on this triple witching Friday, and that's going to be ahead of a benchmark index for balancing on Monday. But despite the activity and despite the massive buy the dip day in equities, it's not enough to rescue the broad market from what will be a second straight weekly decline. Bank of America strategist Michael Hartnett in his weekly note saying equity breath remains dire, and that's illustrated by an S&P equal-weighted index that over the past week is sitting on double the losses of its cap-weighted counterpart. And frankly, well, the rally today almost didn't happen. As Alex was just pointing out, S&P futures were deep in the red in the pre-market and only reversed higher when that PCE report hit. It's a report that did show the Fed's preferred measure of underlying inflation was muted in November, and that's raising hopes for more rate cuts. But San Francisco Fed President Mary Daly, who spoke prior to that report, she said recent data suggests the Fed may not have to cut rates too much more anytime soon.
Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought.
And Daly, in that Bloomberg interview, was also asked about the impact of the incoming Trump administration. And while she did say the economy could be a little more vulnerable, given inflation has not yet fallen to the Fed's 2% target, she declined to go into any specifics head on. And maybe there's a good reason why she won't or can't get into those specifics, because no one really knows what's going on in Washington. Right now, Republican leaders still behind closed doors trying to strike a deal again, Alex, to avoid having the government shut down at midnight.
Oh, yeah. It's like redux again. So this is a chart that sort of amplifies what we're looking at. So let me just break it down for you. The yellow line is the 10-year yield. The blue line is the S&P. And going back to 2010, these are how many government shutdowns we've had, indicated by the red dots. Now, I want to take your focus here to the one back in 2013, because Libby Cantrell over PIMCO says if this government shutdown does happen, it would be a full government shutdown, 2 million employees, right? The last time we had a full government shutdown was back in 2013. It was a full 16 days and shaved about 0.6% off of GDP. So what did it do to the markets? Honestly, I have to be honest, not a lot. So you take a look at what happened to the 10-year yield. Yes, it did bounce a little bit during the government shutdown. Okay, so you had some risk aversion there. For the S&P, it was but a blip, which goes to the idea, Romaine, that for the equity market doesn't mean anything. For the bond market, though, there are some questions. Will we see more volatility there? Particularly the debt ceiling, again, is wrapped into it.
All right, let's kick us off to the close here on this festive Friday afternoon. Alex Petrone joining us, Director of Fixed Income with Rockefeller Asset Management, the New York-based division of Rockefeller Capital Management. And Alex, a lot of us right now on Wall Street are much more focused on what's going on in Washington. Does it matter?
It does. Mm-hmm. It should. The markets right now are largely shrugging it off. As you pointed out, if you look at equity markets, if you look at bond markets, they really responded to PCE this morning. And so that seems to be the story of the day. Now, if we go into a shutdown and it is protracted, we can anticipate it will have an impact on the market, and that rate volatility should persist, and then we would react to that.
This gets to a point that Mary Daly made this morning when she was asked about it, and she dodged the question as you would expect a Fed official to. But she did kind of point out this idea that the economy is still in a somewhat fragile place. Yes, it's doing well, but inflation is still above, at least above where the Fed wants to see it. And there are other concerns about the labor market here. What is the state of the economy in your view and the team's view over at Rockefeller heading into 2025?
Sure. Great question. I mean, in aggregate, the economy is on good footing, right? We heard that from Chair Powell this week, and we saw that in really the summary of economic projections. Yeah. Growth navigating higher towards the end of 2025, as well as labor market holding up. But we heard that there are some cracks and some slowdown within the labor market. I think we know what I'm really excited to see from the Fed is the FOMC minutes I think that that's going to be something to read, because then we're going to look not just at the data that we've been considering to this point of inflation and labor and the aggregate consumer and how they're feeling, but then how some of the fiscal policies ahead might shape the economy going forward. And I think, I'm no economist, but most economists will tell you that there are tailwinds and headwinds depending on which policy factor you look at from a fiscal perspective.
Yeah, and we heard from Fed Williams, we were speaking on CNBC, saying that he did look at tariffs when he was making his projections. So some of them are obviously definitely doing that. So who did it and how they projected it will be very interesting.
It's going to be fascinating.
Okay, so what do you do in the fixed income market? Like, do you want to keep powder dry? Do you want to be invested? And if you are, where?
So I think you want to do all of these things. As active investors, yes, keep powder dry in periods where we likely head into another year of volatility, whether it's rates, spreads, sectors. So active management and having some dry powder is really exciting when rates sell off materially. But you do want to stay invested as well, because to your point, Romaine, if the economy slows, I'm a fixed income person, if the economy slows, you want that ballast in your portfolio. What are we most excited about?
Yes, tell us.
We love munis for U.S. tax-paying investors for a variety of reasons. High-yield munis in particular start with really compelling tax-exempt yields. Add in positive credit fundamentals overall, and then layer on top an environment where tax policy matters and continues to remain high here in the U.S.
Right, but what if the muni tax exemption thing goes away?
Yes, great question as well. I think there's several things to consider here. We've seen this time and time again in my nearly 20 years in the municipal market. It is hard for me to comprehend that you could see a Congress move this initiative forward versus using it as a talking point. It's very challenging to see those who benefit so meaningfully from the tax exemption through lower financing costs, which really helps support state and local governments, funding about 70% of the infrastructure needs in the U.S. to move this forward. But, unusual things sometimes happen with the federal government. If we were to see a move forward, either in eliminating the tax exemption or capping it at a certain percentage point, which I think you all noted about 28% earlier this week. Yep. I think realistically you come back to grandfathering in existing tax exempts, and then the value of the market as it stands today goes up.
A dumb question, though. If we do get tax cuts or further tax breaks, particularly on other asset classes, there's been a lot of talk about reducing the capital gains tax and other things here. Does that create more competition relative to munis? Because, I mean, part of the appeal, of course, obviously, is the tax exemption.
Absolutely.
Yeah.
We are really focused on tax exemption, tax efficiency. So if you see tweaks in other markets that makes it more attractive to go outside of the municipal market, yes, absolutely. You have to think about muni to treasury ratios or tax equivalent yields across sectors, whether it's thinking about corporates, QDI preferreds. We do that today. But when you look at the municipal market, particularly a little farther out the curve, 10 years and out, 70, 80, 85, 90% tax-exempt tax equivalent yields, or excuse me, rather, muni to treasury ratios. Right. That's pretty compelling. You need to see a material move.
Is the demand there? I mean, I know Rockefeller has launched a bunch of products this year. You guys, I think just a couple weeks ago, announced a new interval fund. And then earlier this year, correct me if I'm wrong, you have a couple ETFs in that space.
3 ETFs.
Well. So that the demand is there for that?
The demand is there. And you've seen over several years shifting demand towards more active municipal ETF structures. And then the municipal market in particular, because we are a highly fragmented, highly inefficient market, because of the number of issuers, the retail presence, an interval fund is really a wonderful structure for being able to capitalize on liquidity and complexity premiums in our market.
All right. This is a great conversation. Great to have you here. Of course, what for a lot of us is our final working day of the year. Not to rub it in, Alex Steele. By the way, do you have a favorite holiday tradition?
You're off the 29th and 30th, too?
Maybe.
Who approved that craziness?
Alex Petrone, Director of Fixed Income with Rockefeller Asset Management, kicking us off here on this festive Friday afternoon. A countdown to the close and a temperature check on CEO sentiment. Teneo's Paul Keary discussing how America's business leaders are feeling as we head into 2025.
All right, plus you got Novo Nordisk shares shedding lots of pounds, and I mean serious weight, 17%, why the pharma company's latest obesity shot is losing its GLP-1 race.
And a conversation on the global implications of the Trump presidency. Raghuram Rajan, professor of finance over at the University of Chicago and former Bank of India governor, going to be joining us in just a few, right here on The Close, right here on Bloomberg.
President-elect Donald Trump's election victory has led to soaring confidence in the U.S. economy, and that's according to a new study by Teneo. Now, we spoke to Paul Keary, Teneo's co-founder and CEO, about where CEOs are looking to invest next year and all the reasons behind that optimism, and also some of their concerns in the year to come.
I think there's concern still on geopolitics. That optimism is not blind to the geopolitical roiling in the Middle East, concerns over what the impact of a conclusion of the war in Ukraine, the role of West interaction with China. So there's concerns over trade and tariffs, but it's almost despite those known issues, there's an expectation that the conclusion of elections around the world, not just in the US, will provide clarity of policy, stability of engagement, so that optimism is there despite the challenges. They're not blind to those issues.
When you talk about the stability, though, I mean, this gets to the idea of what CEOs are supposed to do, which is obviously guide these companies through any circumstance, good or bad. And we saw some companies that really managed to pull that off during the first Trump term. I think of Tim Cook and the job that he did at Apple. Now you have kind of a whole new types of companies now that are going to be facing challenges from some of the administration's policies. Even though there's opportunity there, when they talk about a balance between the good and the bad, what are they telling you?
So there's a lot of data for first-time CEOs dealing with the new Trump administration or long-term CEOs. You've got the first 4 years of the administration. You've got pretty much an always-on campaign stance by the former president in the intervening 4 years. And you've got the policy declarations leading up to the election and the nominations for the cabinet. So there's a lot of data out there for CEOs to prosecute and think through that might impact supply chain, that might impact M&A ambition, that might impact a regulatory environment that might be supportive of said M&A. I think the access to capital is going to be a clarifying moment as well. So I think one revelatory point in this survey is, despite the disruption, despite the global challenges, access to capital, expectation of a lower, more benign regulatory environment, lower tax expectation, that's driving optimism. And M&A, for example, is a primary, I think, beneficiary of that optimism as well for next year.
Do you think that corporations, particularly on the M&A side and just deal making overall, do you think that some of these corporations will be more aggressive over the next 4 years than what they were in the prior 4 years?
Yes, I think our data suggests overwhelming level of optimism, and M&A is a key aspect driving that optimism. Some of the more regulated industries, finance, healthcare, I think, felt boxed out due to the regulatory regime in the US over the last 12 months particularly. So that changed or normalization of the regulatory environment is driving M&A. And there's a historically low level of M&A, as you guys have reported, in media, in tech, in manufacturing. So the expectation is that there'll be normalized, if not aggressive, levels of M&A in those spaces too.
So you went out right after the election, but that doesn't encompass the Fed meeting this week, where really sort of recalibrated the long-term outlook for rates for next year. How are CEOs looking at rates? And if we don't get 4 cuts next year, we just get 2 or maybe less, does that make them rethink their access to capital, rethink M&A?
As you covered this morning, there is surprise as to why the market's so surprised, considering the signaling in relation to rate cuts. From a CEO perspective, their expectation was for the Fed to have the sort of action that they would take. It's factored into their planning for 25 and beyond. And their expectation is that the access to capital, there's about $1 trillion of private equity capital that's going to be unleashed largely into the US economy over the next 12 months. So I think they are looking at the positive sides of this balance sheet, which is greater access to capital, better regulatory environment, and there's been a pent-up demand for M&A. That rate cuts have been factored in largely to that, if it's a normalized rate environment next year.
When we take a look at taxes, going from like 35% to 21% in the first administration for Trump versus 21% to 15%, that jump down is not as dramatic as before. So do you get a sense from CEOs that like they're super excited like they were in 2016, or is there an acknowledgement that this is a different kind of tax regime shift?
Yeah, I think there's a couple of factors that one should think about. Maybe juxtaposition to that is all roads lead to the US from global CEOs as to where is the most attractive investment destination, 90+%. So I think there's challenges in the European economy. I think there's some challenges still to be ironed out in relation to the West interaction points with China. There's a lot of optimism of capital moving into India, but US is still the largest likely destination for capital, domestic and international next year, which is not just leading to potential economic expansion on the macro, but 50% of CEOs said they were going to hire more people in the US, they're going to invest more capital specifically into the US. So the America First economic agenda is resonating with CEOs, not just domestically, but all over the world.
I do want to ask you about how these companies operate internally, particularly when it comes to some of the initiatives they had in the past on social issues, whether it was fighting climate change or diversity and equality initiatives, things that are really in the crosshairs now, particularly with the new Trump administration coming in. You've had several companies back off of DEI pledges. Just today, we learned that a couple of banks have pulled out of climate change agreements. Are most of the CEOs that you're talking to, do they not see value, or let me rephrase that, do they see too much risk in sticking by some of those initiatives?
Yeah, great question. So we're working with CEOs every day on big strategy issues, including ESG concerns. And then in the survey, it was a specific area of focus. The two interesting data points, I think, partly remain to that. One is there vast majority of companies are rethinking what their ESG priorities are, relabeling certain ESG initiatives. That is not surprising to me because ESG is never static. It's a dynamic condition. And every CEO has to work with the legal, the regulatory, and the social environment, the hand that they are given. And as a consequence, they are working through what is the right ESG strategy in line with the current political and regulatory and legislative environment. But I think very tellingly, almost 100% of CEOs saying they're not going to be dissuaded from recruiting and retaining a diverse workforce because it makes good business sense. It had always been a core focus. So I think we have to separate D&I and ESG. Obviously interrelated, they're simpatico, but they're separate priorities for businesses.
I have to ask you about artificial intelligence as well. Obviously, that's been the big story for the past 2 years, but it's a costly story. I mean, companies are spending a ton of money now to sort of invest in this space, whether for themselves or for their clients and customers. The payoff, though, we haven't necessarily seen. It hasn't shown up necessarily in the earnings report just yet. Do you think companies will stick by some of those investments that they've been making in that space?
Yeah, overwhelmingly, AI is the number one, not surprisingly, investment commitment for 25. Distant second and third is quantum and crypto and DeFi related investment.
And that was Paul Keary, of course, the co-founder of Teneo, really talking about the idea here, Alex, of sort of what CEOs will really sort of be mindful of in 2025. And of course, they have their fingers on the pulse because they obviously consult with these CEOs. They give them a lot of advice. And of course, they did this big survey, which kind of started, I guess, right before the election and was completed after the election. It's kind of interesting to see the results. And one thing he talked a lot about was the focus on tariffs and the concerns here about an increase in those tariffs during the Trump administration. And
it's interesting to see if that outweighs at any point the otherwise optimism. So this chart, Torsten Slok of Apollo sent over today in his note, and it looks at Bloomberg data, but it takes a look at the mention of tariffs from companies. And you can see that just that jump in December, how extreme it is. And it was pretty broad-based. It was healthcare, it was tech, it was industrials. It was a pretty broad-based look.
Yeah, I mean, and I love this, and it gives you a sense here of exactly why this is an issue, right? I mean, people care. So this is what people are going to be paying attention to. I would love to see that chart pulled all the way back to 2016, though.
Yeah.
As well, like, during the first Trump administration, see how it compares.
That's such a good point. Okay, I think we can do that. It's our data. We just have to make it happen.
We can, yeah. So when I was saying I was hoping we can do that, I was saying hopefully somebody in the control room can do that. All right.
No, because that's a Viz graphic.
All right, we're sliding into a holiday week. It's a holiday shortened week next week, Alex.
So I hear, and I hear you're off for like a month and stuff.
Okay, all right. Well, we got a lot to cover here. Before we get to that, unfortunately, we're going to talk about weight loss drugs, and we're going to talk about Novo Nordisk. The share has taken a huge dive today, down 21%. Why? Well, we're going to answer that question when we come back after the break. This is The Close on Bloomberg. Novo Nordisk, the ADRs here in the U.S. down more than 20% after the company's experimental obesity shot failed to meet weight loss expectations. Eli Lilly Zepbound now in the lead, with analysts expecting the market to hit $130 billion in sales by 2030. Emily Grafeo joining us right now of Bloomberg News. Talk a little bit more about why such a severe market reaction to this. They already have a weight loss drug, one that's pretty popular, I heard.
Right. So they already have Ozempic, but they're trying to advance to the next stage of weight loss drugs, and so are their competitors. So they had this trial of a new drug, and they said that it was going to cause patients to lose 25% of their body weight, and then the results came out today, and they said that they only lost an average of 20.4. So, I mean, it is a really big reaction to the stock,
All right.
Well,
but I would take 20% off my body weight.
Well, also, there was a caveat that Bloomberg Intelligence pointed out that apparently fewer patients in that trial opted to take the highest dose. Oh. So you may not have gotten the full ability to lose all that weight because you weren't at the highest dose. But clearly, we're looking through that right now.
Yeah, I mean, nevertheless, the stock had been on a tear over the last few years. I was looking at its performance even in 2022. When the S&P 500 was down, it was up over 20%. So they've really been a beneficiary of the weight loss drug trend. And they kind of needed, I guess, to show that they're still the number one company. And then when you compare this to Eli Lilly, one of their competitors, that stock was higher today.
I do wonder, though, I mean, do we have any evidence that people are choosing one over the other, one drug over the other, based on the efficacy? Because I know a lot of people are making the choice based on what's available.
That might be a better question for our wonderful Bloomberg health reporters. I'm not entirely sure, but
it raises the question: is it a first mover advantage, or is it the least amount of side effect advantage? In which case, the barrier to entry would be smaller if you can create the better drug. If it's like a first mover, you're in it, that's going to be totally a different story.
You look at what Wall Street has to say. It was all about Eli Lilly today. Mizuho said Lilly is now the preeminent player in the market. Citi said that. They said that this was a best case scenario for Eli Lilly because Novo's shot could have eroded Eli Lilly's market share in the heaviest patients. So there are some details here when it comes to exactly what kind of patient is taking the drug and the efficacy.
You know what I wonder? I wonder if they're going to see a spike in activity after the holidays. Because, everybody stuffs their face over, between Thanksgiving, Christmas, Hanukkah, everything else. And then January, you wake up and realize, I just put on 15, 20 pounds.
I'm off gluten right now.
Other
off gluten. Listen,
go higher.
You love. What's your favorite Christmas treat?
We were just talking about all the Christmas cocktails.
I gotta say, drinks.
Yeah,
that's what that is.
An espresso martini,
but fancy ones,
Right.
In the holiday spirit.
I don't think
and thank you
espresso
for
martini is
dressing
Christmas,
holiday appropriate today.
Yeah.
We appreciate the.
It's chocolatey.
Thanks a lot. Happy holidays. Emily Grafeo joining us from Bloomberg. All right, coming up, Raghuram Rajan is professor of finance at the Booth School of Business. His outlook on the global economy. It's The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So a big part of the trade that we're seeing going into 2025 is the U.S. exceptionalism, right? But a lot of that hinges on the outperformance of earnings. It hinges on taxes, and it hinges on a lot of money coming into the U.S. and being used and built.
Yeah, well, built is the big question here. And right now, you're seeing new surveys coming out, including among business leaders, basically saying that, at least for right now, they're not going to spend a whole lot on CapEx. Now, this is primarily in the manufacturing sector. There was a survey in the for the fourth quarter by the National Association of Manufacturers showing that they were only anticipating about a 1.6% bump in CapEx spending next year. Now, the caveat is that things could change once the new administration comes in and some of its business-friendly promises. If that turns out to be true, then maybe that the amount of investment goes up.
Which dovetails to Teneo, because he was telling us that 50% of CEOs are going to put more money into the U.S. and hire more workers into the U.S. So our next guest has an interesting take on the global economy. He says the world is fragmenting, slowly but surely, and global trade as a fraction of GDP has been flat since the financial crisis, and foreign direct investment has fallen. And now, the richest, most powerful country in the world, this is the United States, is turning against the global order it built. We must resist the play's overall theme that isolationism will make every nation great again. Joining us now is the author of that piece, Raghuram Rajan, professor of finance at the University of Chicago Booth School of Business. Raj, always a sincere pleasure to talk to you. Your piece was quite fascinating and really took a look at the isolationism precedent that's being set in part by the U.S. Walk us through your thinking and how you think this will develop under President Trump.
Well, I think the reality is that the U.S. is moving along a path where, it considers trade deficits as bad. And it believes by reducing those deficits with every country, it'll bring a lot more jobs back into the United States. This certainly is President Trump's beliefs. He calls himself the tariff man. I think we are going to see substantial tariffs, certainly on China in the new administration. Part of the reason that's going to happen is that first, ideologically, they believe that this will reduce deficits, bring jobs back to the United States. Unfortunately, there's not that much evidence it'll do the latter. Second, they believe that this will actually be a source of revenues. And clearly, the Trump administration has a lot of tax cuts it wants to make, and this will compensate somewhat. And third, it will hit against a great geopolitical rival, China. So I believe that while some of the threatened tariffs may be a negotiating ploy, we will see some being levied on China.
And Raj, from your work, it seems like that's not the actual issue that we're combating, right? It's actually when there's huge technological innovation, that's when workers become disillusioned and they don't have another career. So if it's not actually fixing the problem, is it going to hurt growth in the U.S.? Is it going to raise inflation in the U.S.?
I think the studies that have looked at this in the past do suggest that it's not particularly helpful for growth. It's not also helpful for creating jobs. And so in that sense, why doesn't it create jobs? Because even if, you levy tariffs on one country and you don't see trade shift to another country. So, for example, we levied tariffs on China and suddenly started importing so much more from Vietnam, through which the Chinese goods were passing. Even if that doesn't happen and you somehow bring the manufacturing back to the United States, it's not going to be done by workers. It's going to be done by machines. And that's the real problem, that technological innovation, the improvement in machines, robotics, etc., makes it much easier to manufacture, even in a poor country like India, with machines rather than people. And that's what we're combating, not really the Chinese worker, but the Chinese machine.
Yeah, unfortunately, though, that's not the political narrative, at least not the one that's being sold to actual voters. So we're now in a situation here in the U.S. where there's going to be a lot of changes starting in January, at least in theory. And some of those changes are contradictory. And I am curious, there's been, I guess, a broader debate here about kind of the end of, I guess, what we would call kind of liberal democracy, kind of that sort of post-World War II economic order that was dominated by the United States, and whether that truly is over, and we are setting up for, I guess, more fiefdoms, or maybe another player rises up to be that global dominant player, whether it's China, maybe India, or maybe Europe gets its act together and fills that role.
Well, the U.S. is still the world's preeminent economy. And with the innovation that goes on in the United States, it is likely to stay that way for a considerable period of time. The question really is, does it take the world along with it? And, America First certainly may help America in some ways, but if it, hurts the rest of the world, eventually it hurts the United States also. So, take, for example, the tariff proposals that are being suggested. It's not that the rest of the world is going to benefit from that. It's going to be hurt. China, the thought is that, 60% tariffs on Chinese goods will reduce Chinese growth by about 2.5 percentage points, other things remaining equal. And China is already growing very slowly. Now, that means that China is not going to be a consumer for example, U.S. goods down the line. And so this is problematic. You're not living in isolation. You're living in a world where others buy your products also. So this is why a strong U.S. economy, if it carries the rest of the world along with it, it's good for everyone, including the U.S.
I am curious, though, but the U.S. and its policies, and this isn't just about Trump or even Biden, but really going back decades now, we've had the ability to kind of dictate what we wanted to the rest of the world because of the size of our economy and our reserve currencies and everything that goes along with that. If we do believe that that's ebbing and that someone else may try to fill that role. I'm kind of curious about the fact that the countries that would fill that role don't seem to want to. I mean, India's made it clear it has no desire to be a global arbiter, if you will. China and Xi Jinping, I think, have also kind of made that clear as well. They're content with dealing with their own economies and their own regions, independently of maybe what somebody's doing 5,000 miles away.
We have to find a new order then, because a order in which the U.S. acted responsibly and put out for others. That was the post-World War II economy. In a sense, the U.S. was preeminent, but it worked to make it work for everyone else also. If the U.S. backs off from that, we will need a new world order, but which is more self-managing. Because as you said, there are 3 or 4 big players, including the U.S. No one wants to take responsibility. Nobody's going to make the system work. So in a sense, you need, in fact, more rules to keep everybody in check and balance. But of course, there's no agreement on what those rules might be, which means we get more fracture rather than cohesion.
Do you have any hope that there will be enough consensus globally for a new set of rules? Because right now we seem to be in the teardown phase of all those old rules.
I think we have to see the breakdown and see the consequences of breakdown, the consequences of everybody levying tariffs against everybody else, or preventing the flow of capital or investments across borders, to realize that's not a place we want to be in. Unfortunately, we have global problems like climate change. We require cooperation, and which are not going to stay while we figure out that cooperation is actually better than conflict.
I have a really unsophisticated question to end this conversation with, Raj. Taking all of this, what should the central bankers be doing? Like they're cutting right now. Is this the right way to be approaching this potential very dynamic global economic environment?
Well, for countries outside the United States, they fall into 2 buckets. One for whom growth is going to be the bigger problem, that's Europe, where they're cutting. But there are other countries where, the exchange rate is going to be the problem because the U.S. looks strong, and with the Federal Reserve staying high for longer, their exchange rate depreciates against the dollar and creates problems domestically. So a country like Brazil has been quick to raise interest rates now to combat that. And of course, that hurts their own growth. I think the U.S., the biggest issue right now is uncertainty. What the new administration's policies will be and how the Fed will react to that, given the fact that some of those policies may in fact be inflationary. So my sense is the Fed, correctly signaled that it's going to wait and see, maybe wait a little longer until it sees those policies roll out. Everybody, of course, else is waiting on the Fed.
Absolutely. It's going to be an interesting 2025. I'm going to wish you a happy holiday season, and we're going to leave it there. Dr. Raghuram Rajan, of course, former chief economist and director of research at the IMF, former Reserve Bank of India governor, one of the great minds in economics now, teaching the next generation of great minds over at the University of Chicago. We want to switch from that to our top calls. This is where we take a look at some of the big movers on the back of analyst recommendations. And we're going to start today with an upvote for Reddit. Guggenheim Securities initiating coverage of the social media platform with a buy and a 210 price target, with the analyst saying Reddit is poised to capitalize on strong social media growth in the quarters and years ahead, given its highly engaged user base across the world. Those shares having a great day, up about 4%. Next, BlackBerry upgraded to buy from hold over at TD Cowen after a better than expected third quarter report. The analyst, a fan of the tech company's low valuation, and says the upgrade reflects significantly improved cash flow expectations. BlackBerry having its best day since at least 2021. And finally, Brinker International, a lift to equal weight at Morgan Stanley. Recent sales data showing that the owner of Chili's and Maggiano's Little Italy performing well, and further highlighting the analyst's view that a turnaround story has legs. He does, however, caution that the stock could be sensitive to an earnings miss or slowing rate of change. Investors shrugging that off for now, pushing the shares higher by 3%. Those are some of our top calls. We're going to turn now to the all-you-can-eat sector of the world, cruises. It's smooth sailing for shares of Carnival after an earnings report this morning showed record levels of demand that will continue into the new year. The CEO sat down with Bloomberg just a little while ago to talk about the company's quarter.
As a matter of fact, in 2024, we had over 10% more new to cruise than we did the prior year. So becoming more mainstream, breaking down myths, and that value gap is real. So we can still increase our pricing as we've been doing the last few years and be an incredible value.
Josh Weinstein, of course, the CEO of Carnival, and joining us right now is David Katz, equity research analyst at Jefferies, who follows this company and has a buy rating on the shares. David, you like what you heard out of this earnings report and the CEO?
We did. We actually published just a few days ago that Carnival is one of our top picks for 2025, and several reasons for that. We think that the demand curve is still accelerating. There is a value gap, as Josh pointed out, versus hotels, which we also cover, which are getting a bit expensive. But I think Carnival also has the benefit of a CEO transition that's 2 years into Josh Weinstein. And we do think that there's change afoot for the better. And finally, they came out of COVID with 3 times as much debt as they went in, and they're still, eating through that. And that should go on for a couple more years.
I'm curious when it comes to the growth story here, David, is there an opportunity to pull in new customers, meaning people that aren't Carnival customers, and for that matter, maybe not cruise line customers at all? Or is there a growth story about just monetizing their existing customer base?
No, I think Josh pointed that out as well. I think in 2023, the new to cruise customer base was about 28%. Now we can't prove, but it is evidence that customers are trading out of a more expensive option and into cruise because of that value proposition. And the increase in new to cruise customers, 10%. That's further evidence that there is some trading down going on across our coverage universe toward Carnival. And that's one of the reasons why we hold it out as a top pick.
So I was going to mention, does that mean that this is a cruise line specific positive call because of that? Or is it a Carnival specific because of that value proposition, but just for Carnival?
Well, look, I have my own limitations because I only formally cover and rate Carnival. But it's pretty obvious that the other stocks in that universe are working quite well also. They're executing quite well. And so, I can tell you from my conversations with clients, there is a positive view on cruise as a category. Within it, Carnival is the largest and does have those other benefits that I pointed out earlier, the leadership transition, the balance sheet, fix up. Those should add to some of the earnings growth and value growth here too.
David, when we take a look at what Carnival can actually offer, does it come at the expense of then the hotel stocks, say, that you cover? And that trade down effect, right? Like the better Carnival does, do we learn something about the macro economy?
Well, 2 questions there and 2 answers for you. On the first part, it does, right? We see how hotels are doing on a weekly basis across North America and across Europe and elsewhere. Our coverage is mostly focused in North America. But you see some of the lower half of the pricing scale has been moderating for some time. For a good portion of this year, those RevPARs were negative, and they've just more recently turned a bit positive, right? While the higher ends are still gaining some. Carnival is a value offering, right? And it is that same customer. So to the first part of your question, yes. But I do think that there's an evolution of what the product is that is bringing new people in.
All right, David, first part of the question and answer. We'll get you back for the second part when I throw 2 for at you. David Katz joining us over at Jefferies. Thanks a lot and happy holidays. All right, we're about 15 minutes away from the closing bell. What a wild day it was. A very different setup than where we were positioned about 7 a.m. this morning. Nancy Tengler, CEO and CIO with Laffer Tengler, will be joining us. This is The Close on Bloomberg.
If you look at equity markets, if you look at bond markets, they really responded to PCE this morning. And so that seems to be the story of the day. Now, if we go into a shutdown and it is protracted, we can't anticipate it will have an impact on the market and that rate volatility should persist. And then we would react to that.
Alex Petrone at Rockefeller Asset Management kicking us off to the close just about 50 minutes ago here on a festive Friday afternoon, Alex Steele. And look at the rebound in stock prices today. I mean, we had that massive sell-off on Wednesday, didn't get much action yesterday, but some people buying the dip here.
Yeah, the second we opened and then we got that PCE, we really saw that buy the dip. Now, looks good, right? Pretty much across the board, whether you're looking at tech or the S&P or the semis or the Russell. But if you still look at it on a weekly basis, the S&P is still down 2%. At one point, it was headed for its biggest weekly drop in almost 4 months, but that rally today really saved it. You see that BTIG note that said, look, the washout did its work, and now we're ready. We're ready for the Santa Claus rally.
Yeah, it'll be interesting to see how much conviction is behind that, right? I mean, because you get this idea that, what sort of led to the sell-off, right? It was all of a sudden uncertainty about Fed policy, uncertain about fiscal policy, uncertainty about tariffs. And I don't know, did we resolve all that over the last 36 hours?
I don't know. Don't we have a government shutdown coming? Where's our countdown clock?
I don't know. I was told government shutdowns don't matter. Nancy Tengler is joining us right now. She always matters. CEO and CIO with Laffer Tengler Investments, helping us count you down to the closing bells. Great to see you, Nancy. I do want to start off with our wonderful, wonderful folks down in Washington who are behind closed doors right now, hammering out a budget agreement that will basically just prevent us from shutting down for a couple of weeks, and then they'll deal with this in January. I have to ask you the standard question, Nancy. Do these types of battles in Washington, do they have a material impact at all on financial markets?
Thanks for having me, Romaine and Alex. I would say ultimately no, but in the near term, yes. And I think in this particular case, what the market is struggling with is the assumed Trump agenda going to be able to be enacted. If they can't get this done, the concern, I think, is that we may have some trouble getting tax cuts and deregulation. So I think there's some of that going on. And then, of course, we all know we had the Fed yesterday, and that created at least headlines that the algorithms reacted to. And so I think that's part of why you're seeing a bounce back today, as well as PCE came in pretty tame.
I'm glad you brought up the Fed, too, because, again, this seesaw, right? We go back to Wednesday and what Jay Powell had to say. Of course, a lot of people looked at the quarterly PCE data and saw that uptick in inflation. Then we got the monthly numbers this morning, which showed, okay, maybe, inflation isn't quite out of control as maybe the previous numbers had suggested. So it just seems like we're kind of going in circles here. Does it change the overall trajectory, though, that the market has counted on, which is that overall we are on a disinflationary trend?
Yeah, no, I don't think it does. I think there's blips. And again, because we have such a short-term focus for many traders in the market, you get these reactions. But if you're a long-term investor, you use them as an opportunity. Volatility is the friend of the long-term investor. So you want to step in, because I do believe we're in the early years of a bull market. We've talked about this before, the analogy to the 1990s, and productivity really is the theme in this environment as it was in the 90s. So I think we continue to see, stronger earnings growth. Although there was one troubling thing that I noted, and that is that corporate tax receipts came in below where they were last quarter, which is usually an indicator of where earnings growth is going to be for the quarter. So we may get a little bit of a slowdown. But again, I think we're in good shape for the next couple of years in terms of earnings growth, somewhere between 14 and 15%. If we get tax cuts or a corporate tax cut, let's say we get to 18 instead of 15, that adds almost 4% to S&P earnings growth. So I do think there's a lot to be optimistic about. There's just going to be a lot of noise.
Nancy, top call for 2025.
I still like technology 100%. I think not everything, not every chip name, but we own NVIDIA and Broadcom. We like, a number of the software names. ServiceNow has been a big name for us, and Spotify. So we're pretty optimistic. And then we've broadened out into an overweight in consumer discretionary and in industrials.
Yeah, consumer discretionary was on a tear over the last month. I felt it was just like record after record after record. Is an industrial call part also of lower taxes as well as administrative policies in D.C.?
Yes. And also, Alex, we're focused on our theme, which is old economy companies pivoting to the new technology. So we like, we don't like every industrial name, but we like the number that are utilizing technology to improve their margins and using digitization and generative AI. So we're pretty optimistic, as I said, that this is not this isn't a stall out. This is just a much needed correction. We didn't even get a full correction yesterday. We'll probably get one in January. I'm okay okay with that. We'll be adding to holdings just as we have been in some of the names over the last few weeks.
Nancy, it's always a pleasure to talk to you all year long and all the years prior to that. Always a joy and always great insights. We'll catch up with you in 2025. Have a Merry Christmas and a Happy Holidays there. Nancy Tengler, CEO and CIO at Laffer Tengler Investments, helping us count you down to these closing bells. Those bells just about 4 minutes or so away here. Alex, we talk about the rally on the day, but I think as you pointed out, on a weekly basis, it's pretty much red up and down the screen. 2 straight weeks of losses now for the S&P, 3 straight weeks of losses for the Dow and the Russell 2000.
Yeah, and the question then being, is the buy the dip sustainable? Or I know volume wasn't terrible, but as we get towards, obviously, the end of the year, as I was mentioning, BTIG was pointing out that Santa Claus rally is usually the 24th of December through January 2nd. So there's just a handful of days where that could happen. And then do we continue this rally through that time? Yeah,
and it's though interesting, too, when you look at the almanacs. And, of course, these Santa Claus rallies tend to get disrupted in in transition years, political transition years, where you have a new administration coming in as everyone tries to figure out sort of what happens next. I was going through some of the best performing stocks on the week. Darden at the top of the list. Yep. A lot of that today with the big rally. Match Group, Palantir, Fox, Boeing, not your typical names that you'll see at the top of the leaderboard. And maybe that's why we're in the red on a weekly basis, because you're not going to find at the top of that leaderboard Meta, Amazon, Nvidia, Tesla, et cetera.
Yeah, no, that's a good point. And we talk about the broadening of the rally as well. Like, we're one-off names at this point. It's not a consistent rally there. Now, just in the last month, though, top of the list, Broadcom, Ulta Beauty, and Lululemon. So again, you have that consumer discretionary that has just continued to do really, really well. It's hard to square that with employment worries and inflation worries.
We should point out also a big sell-off this week in the bond market, a big sell-off in the energy space too as well. You talk about that drop that we saw in crude oil down 2.5% on the week, still below, at least WTI, below $70 a barrel.
Yeah, and you want to see where the confusion is going to be for next year. A good part of it's going to absolutely be in oil, because you have a supply thing and you also have a demand thing that is totally TBD depending on tariffs at the end of the day.
All right, one of your big winners on the week, you actually find that in the FX space, the dollar up about a 0.6% over the last 5 days at a 2-year high, and now up 7% on a year-to-date basis. Dollar normally ain't supposed to do that. A full breakdown of all the day's action, a full breakdown of all of the week's action with our global simulcast that starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're taking you to that closing bell with our global simulcast. Scarlet Fu wheeled into the TV studio as always. Carol Massar and Tim Stenovic still in their radio booth as we welcome our audiences across all of our Bloomberg platforms on this
Just kidding.
festive Friday afternoon. Carol Massar, are you wearing black on this festive Friday afternoon?
I am kind of sorry about that. I know. Look at you guys. Look at all the red and the light.
You should see his tie. Romaine has these little tiny Santa Claus on his tie, these bright red socks. It's the whole thing.
That's about as festive as Romaine has gotten this holiday season, huh?
This is the time to shine, Scarlet Fu. I mean, if you can't be festive this time of year, then when can you be?
I bet you go home and you have some Christmas sweaters you put on.
We've got the PJs, we got the socks, we got the hats,
the tracksuits.
We got the whole 9 yards in the Bostick household. So I'll save you a pair if you really want one.
We totally want one.
Right.
Different tone, right, today? I mean, broad-based buying, and we're still, though, on track for not a great week here.
Yeah, off our best levels of the day, but we're still seeing lots of green across the screen. Down, though, on most of the major averages that we follow, Scarlett, about 2% on the week.
How many people think that we're going to get through this Friday with an actual vote and avert a shutdown?
I'm not taking that bet.
Mike Johnson says we will.
I'd rather go to Vegas.
He also said that a couple of times before, too.
Mike Johnson
this
said
week.
That? Okay.
Yeah, he
Good
did.
thing.
He said the government will not shut down.
This is Plan C, remember.
Yeah.
Okay, but remember, markets don't care. Don't care. Markets tend not to care about these
Until they have to care.
Until they have to care. Of course, we are waiting still on a vote out of the House of Representatives. Last time we checked, based on Bloomberg reporting, they didn't even have enough support amongst the Republicans to get that through. Of course, we will bring you that breaking news as soon as it happens. But let's recap what we saw in the markets on the day. Green across the screen. A nice rebound coming off that big sell-off on Wednesday, but not necessarily enough to push stocks into the green for a week. on the daily basis. Dow Jones Industrial Average down 500 points or more than 1%. The S&P 500 higher by 64 points or more than 1%. The NASDAQ Composite up more than 200 points or 1%. And the Russell 2000 up about 21 points or about 1%.
All right, as we dig a little bit deeper, especially into the large caps, guys, most names in the index higher today. The S&P 500, 442, Scarlett, to the upside, and you had about 59 names losing some ground today.
All right, this is going to be a pretty simple IMAP. Let's go to it. It's all green right now. All 11 groups are higher for the day. The laggards here are the consumer names, consumer staples and discretionary up marginally, gaining 0.1%. But your best performers, real estate investment trusts up 1.8%, tech up 1.5%, along with utilities, which have become really tech adjacent.
All right, guys, let's get to some of the top gainers in the Friday trade. Carnival, number 4 gainer in the S&P 500, rallying, lifting its peers as well. Fourth quarter adjusted EPS, it was a beat. Company introduced some guidance for 2025, signaling that record levels of cruise demand will continue into the new year. We spoke with CEO Josh Weinstein. He was so upbeat about what he is seeing in terms of bookings and spending. So it was interesting to talk with him. But
I listened to your interview with him. I thought it was interesting when he talked about the new people coming into cruising.
Yeah.
I forgot what the phrase he used, but the idea that they're bringing in a lot of people who've never, ever been on a cruise before.
Yeah, I think he said 10% more new to cruise in 2024 than 2023, so expanding their market base in terms of people who want to cruise.
Yeah. Nice interview, by the way.
Thank you very much. Yeah. I appreciate that from you. Eli Lilly, also higher today, at its highs up about 7%, finishing the day.
Did you laugh, Alex, Steele?
I did, sorry.
At the close, up about 1%. You guys know the news. Competitor Novo Nordisk out with a new experimental weight loss drug. There was some disappointment, falling short of expectations in terms of the trials out there. So Eli Lilly, as a result, also, of course, big-time player in this space, gaining on that news. I just want to mention, I know it's a small cap, $680 million market cap biotech company. It's called Humacyte. It was up. It almost doubled in today's trade, up about 100%, 95% at its highs, finishing the day with a gain of 34%. What was interesting is that the FDA granted full approval of its bioengineered human tissue product for adults with arterial injury. I just think this is a cool space when it comes to medicine. And then just one more thing. I'm going for 4 today. The Buffett effect. News that Berkshire Hathaway upped its holdings in a couple of names. Occidental, Verisign, and then SiriusXM, which that one was up about 12% in today's session.
Occidental? Why doesn't he just buy this thing at this point?
I know.
Oxy.
Yeah.
Okay, it's Oxy now. They changed their name.
So why
I'm
won't he
gonna
buy
get an
it,
email.
Alex? Why won't he buy the whole thing?
Oxy.
Oxy.
I hear Oxy and I think something else.
Exactly.
Sorry.
What, OxyClean?
Yeah, no.
Oh.
Hey, I didn't make up the name. I'm just like, I'm going to get the emails.
I know. All right, Oxy.
Yeah, send them to Alex, please.
All right. I got the decliners today. I do want to start with Novo Nordisk. Shares fell the most intraday in Copenhagen after a failed attempt to leapfrog rival Eli Lilly in the market for obesity drugs. ADRs here in the U.S. fell by the most since 2002. By the close, down 18%. Novo's experimental obesity shot, CagriSema, helped patients lose an average of 20.4% of their weight over 68 weeks. That was short of the 25% weight loss that Novo had repeatedly predicted for its next-gen product. Once again, shares down more than 17% here. We'll go ahead and round that up to 18%. And remember yesterday's news about FedEx and shedding its freight business, also FedEx earnings. Trucking stocks fell in the wake of that. XPO Inc. shares fell by 7% today. This after FedEx cut its year guidance and said it's going to spin off its freight division. XPO certainly one of those companies. At one point in the trade, it was down the most in nearly 2 years. Bounced off their lows, though, to close at 7% to the downside. And finally, I did want to take a look at shares of Starbucks today. Ended up falling today by just close to 1%. This after the union representing Starbucks baristas went on strike this morning at a limited number of locations in 3 U.S. cities after a final stage bargaining session reached an impasse. In a statement, Starbucks said the union, quote, prematurely ended the bargaining session this week and it's ready to continue talks.
All right, well, in the bond market, we've seen some buying all across the curve pretty much throughout the day, whether you were looking at a steep decline in the equity market pre-PCE or as we opened up and the rally continued. The bulk of the buying, though, continued to be in the belly of the curve, really looking at that 7 and 5 year. On the whole, though, guys, the 210 spread had an unbelievable week. I mean, it's rising for 3 straight weeks, and we hit the highest level since 2022. It's been a very dramatic change, a sea change for the steepener trade.
All right. All right, everybody, we are definitely thinking about the holidays next week. And here's a stat for you. This is coming from the New York Post. Americans are expected to spend about $10 billion or so on unwanted gifts this holiday season. This is according to a forecast conducted by a personal finance website. More than half of U.S. adults, apparently about 53%, or 140 million people, will be left disappointed by at least one present they unwrap in December.
I don't know what to say to that. $10 billion?
It's a lot of money.
In aggregate, $10 billion.
It's a lot of money.
$10 billion is $10 billion in sales for companies.
Yeah, but if you take it and then you go exchange it, like, does that actually increase because you actually wind up buying more or
That's
changing
true.
up? I mean, there's actually an opportunity there.
Or do you just leave it at home or re-gift it?
Or you re-gift it.
Or you re-gift and that hurts you for the next year? I don't know.
This is why we do Secret Santa in my house.
Oh, really?
Yeah. We have a huge extended family too, so
You
it
do
just
it
got
why?
to the
To
point.
avoid the criticism?
No, it just make sure people get what they want, and also
I
it got to
gotcha.
the point where it's like, okay, too
thought it
many
was the
people
thought
to
that
buy
counts.
gifts for. This is getting overwhelming.
Yeah.
Let's just all have one person we buy gifts for.
Do you guys re-gift? Anybody re-gift?
No.
Well, no one's going to say that out loud, Carol.
I know. I'm sorry.
Oh, that's true. No, we never, ever re-gift.
We never
If you
re-gift.
do re-gift, yeah, no, never mind.
My sister had like a re-gifting closet, I think.
Well, I think some people have re-gifting
Wow.
rooms,
Sorry.
yeah.
Oh my
Well,
God.
now I have to keep this in mind anytime Carol gives me a gift now.
Yeah.
Give good gifts. You're
It's
not.
like,
When she
you know,
brings in those cookies,
I mean,
watch out.
I don't know. I mean, it's
They're not
like,
fresh.
today she brought me a necklace. I was like, is this really for me?
I don't know about you guys, but we've been having every day in our show meeting, we have a question of the day, and it relates to what's your favorite holiday memory. And one of the questions this week is what's your favorite holiday movie? And everyone had answers that really ran the gamut. Alex, you pointed out there was an investor note that you
Yes.
saw where people voted in their
An
most favorite
investor note?
movies.
Yeah. So this is from Jim Reed over at Deutsche Bank. They did a whole survey, and it was an investor survey what you're thinking for 2025. And in that, they said, what's your favorite holiday movie? And then here are the top 5. Home Alone, Die Hard, Love Actually, It's a Wonderful Life, and Elf. And then it goes on to like Home Alone 2, The Holidays, Gremlins, for
No,
example. I haven't seen
you
Gremlins
actually
in a
skipped
while.
the best one.
Which
I
one?
did?
National Lampoon's Christmas Vacation.
Yeah, I mean, I'm
Oh,
looking
sorry,
at this
I didn't
list
skip
and I'm
that
like,
one.
what?
I like the
mean,
original one.
Yeah, I mean, that's a
Chevy
great one.
Chase.
Come on now.
Charlie Brown Christmas.
Yeah.
Is the Grinch
Charlie
on
Brown
there?
Crisis. What about Trading Places?
That's a
wasn't
great
on the
one
list.
too.
Okay, that was a Christmas movie, right?
Yeah, that's a-
I mean, anything could be a Christmas. You know, we just watched a movie. My son picked this out the other day. It was called Carry On. It was about a TSA agent.
Oh, it's on
seeking
Netflix, yeah.
To defuse a bomb, but it all happened. It's like kind of like Die Hard. It's a Christmas movie, but not. But anyway, I don't
Is
know.
it?
I can't
It
recommend
came out around Christmas, so it's a Christmas movie.
Oh, I see.
Yeah.
Okay, I understood.
It takes place during Christmas too.
Then it makes sense.
Black Doves, that's a good one for this this Christmas season.
I'm just gonna say Love Actually. I remember bringing it up. I'm like, oh, great movie. And I think it was my daughter was 10 at the time, and then I realized there's a part in it. Like,
I did the same thing.
see? And she looked at me and she's like, Mom, we can't. I don't think I can watch this. And we stopped watching. Right?
What was the part? I don't
the
even
same
know what
thing.
you're talking about.
Google it, Tim.
Okay.
Google it.
Yeah, now I'm lost too. Like what? Is
I
it-
love right at you, girl.
Yeah, I don't think I've ever actually seen that movie all the way through.
I watched it and I
Yeah.
could not get into it.
It's
Yeah,
such
it's
a
a
great
little-
movie, but
Love Actually.
all right, we got to
The
wrap.
cue cards, I just didn't get it.
You guys are all going to be Googling.
Didn't get it.
You're
I
gonna
don't know
be
what to
Goog-
say to these people anymore.
I
Guys,
know.
Happy holidays.
Happy holidays. Everybody be safe, and we'll see you soon. All right, that's a wrap. Our cross-platform. We call it the closing bell. We'll see you all real soon.
And our coverage continues here on Bloomberg Television, a conversation and a look ahead to the hottest topic for 2025, and that might actually be the IPO pipeline. At least that's according to our next guest. He joins us in just a second. Mark Lehmann, head of Citizens, JMP Securities, coming up next on The Close, right here on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic as we wrap up the week here on this festive Friday, Scarlett Fu. And it was a festive day in equity markets coming off of that massive sell-off on Wednesday. A bit of a rebound on this Friday with the S&P up about 1% on the day. Similar moves across the board for the other indices, but not necessarily enough to erase all of the losses for the week. In fact, the S&P down a couple percentage points on the week. The Russell down almost 5% on a weekly basis, despite the green on the screen for the day. The flip side of that is the dollar spot index down on the day, but significantly higher on the week, heading towards what is now a 7% gain year to date. And take a look at Bitcoin. Kind of interesting. Not only did it drop on the day, but this was its first weekly decline in 7 weeks here. So a bit of a breather after breaching that 100,000 level. Maybe risk appetite coming a little bit down here on this Friday as we head into a holiday season. I know you're taking a look at some other stocks, Scarlett. I'm full right now. Hot chocolate and peppermint bark. So talk to me about those weight loss drugs. I'm going to need them in January.
Oh, please.
Yeah.
All right, let's start with Eli Lilly because it's really seen solidifying its lead as the weight loss drug company. Eli Lilly closing up 1.4%, kind of in line with the broader market, but really it's seen as a beneficiary because Novo Nordisk dropping 18%. These are the American depository receipts of Novo Nordisk after its obesity shot failed to meet its own bar for success. So Novo Nordisk told everyone that this new experimental treatment would help people lose 25% of their body weight. Instead, people lost about 20.4% of their body weight. 20.4% is still pretty good, but 25% was what they were telling everyone. So disappointment on that front. Old Dominion Freight losing about 3.5% on the day after FedEx says it is spinning off its freight business as its own publicly traded company. So that is, of course, serving as competition for Old Dominion, especially in that less than truckload business. Now, our top story this hour, though, has to be the U.S. government on the brink of a shutdown. If that sounds familiar, it's because we've been here before. House Speaker Mike Johnson scrambling to come up with a Plan C spending bill before a midnight deadline, but it's not 100% clear that he can cobble together enough votes. This, of course, as Elon Musk and Donald Trump shout from the sidelines. We're going to head over to Washington for the very latest there soon.
Absolutely. We are keeping an eye on that as we await that vote. And of course, that has a lot of people speculating about the potential impact on markets, particularly as we head into 2025 with the new administration and new policies coming out of Washington. Mark Lehmann joins us right now. He's the head of Citizens JMP Securities. Kind of talk about what 2025 may bring. And there is a lot of optimism in financial markets right now, particularly when it comes to deal activity, whether it's M&A or more importantly, new entrants into the public market. The IPO market's been somewhat dormant, at least prior to the last few months here. Do you think we're going to see a meaningful pickup next year?
It will be a meaningful pickup by percentage, certainly for 2024. Certainly not what we saw earlier in 2020 and 21, which were record years. But the way the stocks have acted that have gone public this year, there have been some enormous wins just this week or this month with Service Titan, and obviously earlier in the year with names like Reddit, which we've talked about here, which has been an enormous success. There is more demand out there than supply, and I think there'll be more supply in 25.
Will it be the right kind of supply? Like, I feel like the IPOs we've gotten, particularly lately, they've been very selective, and I think that's maybe why they've done so well. But you always know sometimes when that door opens, a lot of good goes through that door, and there's a lot of things that go through that door that probably shouldn't have.
Yeah, I think there will be the right companies. I think the early entrants usually do particularly well. I would argue that Reddit was one that was very controversial. We talked about that here earlier in the year, and look what they've done.
I was surprised at how well it's done.
It's funny. When they came out, I was very optimistic about their plan. And this is not a new company. It's been around for over 20 years. And I remember when I told my family, my daughter, about their IPO, she said, "Oh my God, they're kind of getting legit." And when your 29-year-old says that, that's about as good as any report. But we see a pretty broad lens at Citizens. We see a wide swath. It's not just technology, which is what a lot of people think about. And the companies are really, really prime for a public market. And I think 25 will show that.
I remember last year at this time, we were talking about this large list of companies that were going to go public, including Reddit, and the anticipation of will they, won't they, and when will they. Do we have a running list this time around for 2025?
I think there is a big. There's 1,400 unicorns out there. That's what we count at Citizens.
1,400
unicorns.
Wow.
Will they all go public? Absolutely not. And some of them are in that kind of size, but aren't growing properly to support a public market. There's definitely a list, and I think some of are on their own agenda. But when you see the evaluations that the public market is giving them, Service Titan had some own specifics that made them have to go public when they did, or there would be some penalties, if you will, some ratchets, which would have been very painful. But I think the performance of those stocks, as well as the receptivity by a broad base of both institutional and retail investors, I think will widen that lens. And you're going to see that in the first quarter. You will see IPOs more so in the first quarter than we did a year ago.
So what is it about Reddit's IPO that companies that are private now, these unicorns that may look to go public, are looking at saying, that's what we want to replicate, that's what we want to get?
A couple things. One is I think they were able to show their monetization path to the public. And I think that was a very important thing that they had to prove. Our analyst, Andrew Boone, laid out what they should be doing. They hit all those numbers as a public company. and that's really important. And I think the other thing that they showed is that the market is wide, right? You're not talking, when you talk about the internet, you talk about internet and digital media companies, you talk about advertising. It's not just housed in places like Meta and Google and other places. There's lots of eyeballs. They have a very dedicated, loyal customer base, and that customer base is paying up, and the advertisers are paying for it as well.
I am curious about a lot of the AI names that are in the private market. Obviously, the granddaddy of them all is going to be OpenAI should they choose to go public. Do you anticipate that most of those companies will try to get to the public markets next year?
Most is a big lens. I think some will definitely test the public markets next year. I think there will be some early advantages for some of the companies that are not the biggest of the companies, but are the ones that are winning and gaining big backing right now. You will see some AI companies go public of scale next year.
Does the timing matter? And I mean, in the context of, say, the next 12 months, I mean, should people sort of, or do you anticipate people will maybe try to rush things in the first few months of the year, or are they going to be patient and see how things play out?
I think it'll be more patience. I think you're going to see some things that are on file already that will go in the first quarter.
Yeah.
I think the summer and fall, I think I would predict the second quarter will be fine. The third quarter should be explosive for next year. That would be my guess. It's hard to predict, but that's what I would see going into the fall.
Okay, so more companies coming to market, but what about the SPAC market? Is that dead? Is that alive? And what is the calculus for a company that, needs to or wants to go public, but is kind of deciding if it's more costly and time consuming to go the traditional IPO route versus a SPAC?
Yeah, listen, I think the SPAC market has been talked about greatly. There's been a lot of carnage along the roadside, yet the market is still open. Raising money for a SPAC is wide open. Getting a company across the goal line that buys a company has been very, very difficult to make a lot of money. We know the statistics. They are not wonderful. So I think boards are going to be much more cautious about that route because you look at the statistics of the companies that chose that path, it's been unattractive. So I think the SPAC market will be alive and well. We're already seeing some fruits of that going into the fall and certainly now. I just think there'll be a temperance for boards to make that decision to go SPAC route because it's just been a tough way to make money for those boards that have chosen that route in the last 3 or 4 years.
Okay, great. Right. Not great use cases
Big
ahead
difference.
of them. So in terms of, Romain talked about Bitcoin earlier and how it got to $100,000 this week, but hasn't managed to stay there, at least at the end of this week. How does that affect crypto-adjacent companies and their willingness to go public? I mean, does it depend on Bitcoin staying at a certain level?
I'm not sure it does. I mean, it's been such a huge success this year, right? If you put money, especially in the last 4 months, given Trump's ascendancy to the White House, I think you're going to see some companies that benefit from that stability. And obviously, it's a very volatile currency, but the stability of that not going away is I think, something that will enable companies that benefit from that. And you'll see that in 2025. You'll see adjacent companies have a much more successful route to IPO. And I think you're going to see that early in 2025. And we've got some at Citizens that are talking to us. So again, this currency has done so well. But I think the most important thing is the question of if is gone. Right? I think that's a really important part of this year. Now, I'm not calling for Bitcoin to go where some of the pundits are going to, but I think the question mark about Bitcoin and the question mark about the adjacent markets has tempered now that Trump will be in the White House January 20th.
Yeah. Some big questions answered already then. Mark Lehman, head of Citizens JMP Securities, thank you so much. Coming up on Bloomberg Markets The Close, Shutdown Showdown. We're going to update you on the latest that's happening on Capitol Hill when we come back. This is The Close on Bloomberg. Speaker Mike Johnson said an agreement has been reached and lawmakers will vote sometime today to keep the government from shutting down at midnight. And of course, his remarks came hours after both President-elect Donald Trump and Elon Musk called for a shutdown. For more on how a potential shutdown could impact local and state governments, we're joined now by Bloomberg Government's Jack Fitzpatrick on Capitol Hill, and this is all part of today's Muni Moment. Jack, just set the terms for us, first of all, as Speaker Johnson tries to come up with this Plan C. What does the Plan C include, as far as we know, and how long is it good for?
Yeah, so we're on to at least Plan C as Republicans run through a few options. They have discussed funding the government through March 14th. They would, the last I heard, include a measure to extend farm bill provisions for a year, so farmers are not without their subsidies and an extension of policies. They have continued to say they're going to provide disaster aid, more than $100 billion in disaster aid. But there are another series of measures that Democrats supported that were pulled out of there. And so Democrats have not signed off on this agreement among Republicans to hold a vote. And until they get bipartisan agreement, we're headed for a shutdown. Now, things can come together quickly in Congress, but right now we're still hearing about Republican plans to bring bills to the floor, presumably to pressure Democrats rather than an actual agreement to fund the government.
Yeah, and so the parlor game continues. And it gets to this question, Jack, that if we can't find some consensus, at least for what is effectively just kicking the can down the road for a few months, then we get that shutdown. And I know there are a lot of talk about how it doesn't matter for financial markets, but there are tangible things. We had a report today how the Department of Homeland Security would have to severely curtail the protection that it provides to things like the Times Square ball drop here in New York City. Other agencies would also have to scale back at a time when we're all traveling and a lot of people are very mindful about their security.
Yes, there are negative effects to a shutdown, and they increase over time. The big picture of a shutdown is if you miss the deadline tonight at midnight, but are about to enact a law, the White House may not even have to legally give the shutdown order if it's a matter of hours after the midnight deadline. Then after that, if it's a short shutdown that only lasts on a weekend, that again is not a really damaging thing. There are grants that don't go out. People are furloughed, but they get paid every 2 weeks. So if it's only over the weekend when many workers aren't supposed to be in the office, federal workers anyway, that's a pretty small impact. The real concern is once you shut the government down and both sides dig their heels in, does it last a significant amount of time? We're not into that conversation yet, but that's when federal workers miss a paycheck after 2 weeks. The morale issues, especially around holiday travel, TSA employees get to be an issue, and even the essential workers are at least affected by the length of that furlough. So the question of length is a significant one here.
Jack Fitzpatrick down at the U.S. Capitol as we await potentially a vote tonight here to keep the government open beyond that midnight deadline tonight. And he talks about this idea of how a lot of things will change come January with the new administration. And that actually applies to the labor situation, particularly when it comes to strikes. We had two basically batches of strikes start up over the last 72 hours, including Amazon workers at key facilities in California and Seattle and some other states, as well as Starbucks workers in a few areas. And the Amazon one is very curious because a lot of what's happening there is kind of dependent on National Labor Relations Board rules that we all know are probably going to change once Trump comes in and is able to reshape that board.
Yeah, so right now they have a little bit of leverage, and you know, especially taking place in the final delivery days before Christmas is when they're really trying to press their advantage. Even if something gets resolved in the new year.
And one of the union leaders said exactly that. He's like, look, you know, we want to make an impact, and what better time to make an impact than when everybody's reliant on Amazon to get their Christmas gifts if they don't show up.
Everyone's thinking leverage constantly, and this holiday season has really been about disruption, whether it's in the government or at some of the customer-facing companies.
A lot more coming up on the show. We're going to talk a little bit about the pullback that we've been seeing in corporate America around a lot of those diversity and inclusion initiatives. It's part of our Bloomberg investigation on the declining workforce for Black Americans. This is Bloomberg. A lot of talk out there about President-elect Donald Trump and the platform that he ran on in the election, pushing against DEI initiatives. But a Bloomberg News investigation shows corporate America was already well ahead of him, pumping the brakes on hiring black workers. And this was especially true at larger companies, where the share of black workers in S&P 100 companies declined the most. Nabila Ahmed helps to lead our equality coverage here at Bloomberg News, and she joins us right now. Give us a sense here of what we're talking about statistically with the numbers.
So we saw in 2020, after the murder of George Floyd and the Black Lives Matter protests, a lot of companies pledged to do better in terms of equality in the workplace and just in the economy in general. Those companies rushed to hire black workers, and we saw that between 20 and 21, the share of black workers rose to a peak of 17% in the workforce. Now what we're seeing is that those gains have been pretty much erased. They're down to about 16, just under 17% of the workforce. And even though the percentages are small, these changes are really important directionally, because it just shows that companies are pulling back.
It is important. And there was a quote in there in the story. There's a great story on the terminal. I encourage everyone to read it. That really jumped out at me. And I'm just going to quote it verbatim. It said, "Unfortunately, in our country, race is a very uncomfortable construct, and that has real-world consequences." And it gets to this idea that if these companies aren't being forced to do this, for a lot of them, they're just not.
That's right. And also as the sentiment shifts in the economy, at the time that these companies were hiring black workers and people of color, they were actually expanding the workforce. Since then, what's happened last year, they cut 127,000 workers. So in those cuts, black people were disproportionately overly represented.
Why is that? I mean, I know that the companies don't give you their explanation for what it is, and I'm sure it's a cross-current of reasons, but based on your reporting, what are we understanding to be the main reasons?
So the reasons are complex, as you say, Scarlett. And one of the big reasons we found is the pushback against DEI. And that started with conservative politicians talking about woke capitalism as being something bad, and that is a catch-all phrase that catches everything from environmental sustainability to corporate diversity. And then we saw the Supreme Court ban affirmative action in college admissions, and a lot of activists then took that decision and said that should apply to the workplace as well. So at that time, we saw a lot of companies start to revise these policies, or at least review them, to make sure that they were still legal. Another factor is that as companies were calling people back into the office, that disproportionately affected underrepresented people because they were no longer able to come from a more diverse area of the country. And then in the rush to hire people, some of those people who were hired last were the first to be kicked out.
Last in, first out,
That's
basically.
right.
Okay,
Yeah.
and so a lot of the people who were hired towards the end were people of color, black people. What you also found in your data, which, by the way, the companies didn't give you so much as you combed through the data that was available, was that the share of white workers is also falling in S&P 100 companies.
That's right. So the share of white workers overall, this is kind of following demographics, is down to just under 50%. But the biggest groups where white workers lost some of that share or saw some of the biggest shifts were in executive and management positions. And some of the gains went to white women and Asian women. White men lost out. They still are very dominant in those executive roles, though. They're just under half in the executive roles.
Was there any evidence that some of these companies will continue some of their diversity initiatives, but maybe do it, I guess, maybe a little quieter than what they had in the past?
Romain, that's exactly right. That's what the companies are telling us, that they remain committed to diversity. But as Jeff Green, who led this reporting, found, is that sometimes when you're not talking about it anymore, your workers feel like you're not committed anymore. And that's the big question of, how these programs can continue. Even, they're scaling back. Even Walmart scaled back their supplier diversity program, for example. They're no longer using the term DEI and various other changes.
And then there's a big question of how you measure this. If they're not giving us the data or they don't want to share that publicly, then how do we even know if they're making progress?
Yeah, and even internally, a lot of companies used to have executive compensation linked to diversity, and they're now unwinding those links because they're worried about the legal implications.
I mean, the other thing that we have to keep in mind is, as robust as the job market is right now, I mean, 4.3%, 4.2% unemployment is not high by any stretch of the imagination. It's a lot less tight than it was in 2020 or 2021. And when the labor market is not as favorable to workers, to employees, then people or hiring managers, senior managers tend to go back to what they're comfortable with, as opposed to, kind of stretching themselves.
Yeah, they want to do what's safe because they've only got so many spots. And interestingly, the black unemployment rate is actually much higher than the overall unemployment rate. And that's what we're seeing playing out.
All right, Nabila Ahmed, thank you so much. A great story here on the Bloomberg Terminal. As Romain mentioned, really encourage people to read it. Corporate America hired more black workers, then it stopped. In terms of how markets closed on the day, I feel like this, even though we still have another week of trading, it feels like this is it for 2024.
Yeah, it's kind of hard to see a whole lot of activity next week, I guess, for those people who are maybe just gluttons for punishment. But it gets to this idea, though, too, of This is a phenomenal year, Scarlett,
It
by
has been.
any measure, at
Yeah.
least in equities. Even you can see that in the fixed income space here. There was a lot of money to be made. You saw that in the riskiest of assets, like Bitcoin. So this pullback that we've seen really over the last couple of weeks or so overall, is that just really just kind of a consolidation until we get to the new year, everyone's back at their desk, and then the rally resumes, or is this it?
It's kind of treading water. I think to your point, like we've made the big gains and people want to see what's going to happen in the new year. There's a lot of optimism and excitement over what's to come, especially because you have a pro-growth administration coming into office. So allegedly, but based on what he said during the campaign. So people are saying, okay, let's just sit back and see what happens next.
Yeah, well, the problem is there's a lot of contradictory policies. It's not that he's not pro-growth, he is, but he's proposing a lot of other things that could sort of blunt that growth.
Yeah.
And I think to me, what was most telling, the biggest statistic I thought was most telling was when you look at the losses in the S&P this week, the cap-weighted index compared to the equal-weighted index, you're getting a sense here that maybe not everyone is buying into this economic story. They're gravitating back to what else? The big cap, big tech, the big cash generators, and not taking a chance on the smaller names.
Well said.
Yeah.
This is The Close on Bloomberg.
Here's our question of the day. If you could live forever, would you? Well, in short, that's the mission of Bryan Johnson. He's the founder and CEO of a company called Blueprint. And after making his fortune in the tech industry, hundreds of millions of dollars worth, Johnson has been investing those millions to slow his speed of aging and reverse the aging that has already occurred. We had a chance to catch up with him about his upcoming Netflix documentary called Don't Die, and the steps he's taken to make that goal a reality. You have to listen.
We really started with this idea that asking the question, maybe the most crazy question one could ask in this moment, are we the first generation to not die? And so we've really tried to deploy a scientific process on every single therapy that could slow down my speed of aging and reverse aging damage. It begins with the basics like sleep, diet, exercise, but also extends into more advanced therapies like gene therapy, hyperbaric oxygen therapy, and other advanced medications.
I am curious, when we talk about sort of this search for human longevity, if not even immortality, dare I say that word, of course, this is something that human beings have chased after for decades, if not millennia, if you will. I am curious as to what's changed over the last few years with regards to our technological process that could potentially make this less a myth and more of a reality.
I mean, if you look at the underlying ability we have as humans now to engineer atoms and molecules, we now have artificial intelligence progressing at speeds we can't quite fathom. We have the ability to engineer reality at every scale, atom, molecule, intelligence, digital. And so now is the first moment, I think just in the past 2 to 3 years, where one could say with a straight face, we may be the first generation that won't die. It really is very hard to disprove. And it's an interesting horizon to contemplate that when we have the ability to work at this level, it becomes a very interesting engineering problem.
Well, I guess that's the question here. Is this a problem that needs to be solved, or is this just a fact of life that people age and eventually they die?
I mean, Don't Die is the most played game by every human on the planet every second of every day. It's the most played game in human history. You know, when death is inevitable, we play Don't Die in other ways. We try to become immortal in our deeds. We look to religion for answers. We contemplate having songs sung about us if we're war heroes. And so Don't Die really is the most universal game played by humans. And now it's just different. It actually is a real game we're playing.
When do you think, though, Bryan, we'll actually get a definitive answer? And I really mean that kind of at the micro context. This idea, you put all this stuff in your body, and we all do some form of this, whether it's taking supplements or just eating certain foods. But it's hard to know whether that supplement I took or that salad I ate is actually having an impact because the net effect of that takes so long to materialize. So how do you measure your progress where you know that the stuff you're doing to your body is actually working?
Yeah, I mean, over the past 4 years, I have become the most biologically measured person in human history. In the past month, I shared, I have the best biomarkers of anybody on planet Earth. I am the healthiest person in the entire world. And we've done this through a process of measuring my entire body, the biological age of all my organs, applying all the scientific evidence in my body and then reporting out the data. We've approached this with the scientific method, and our results are public to be viewed. And so I think there really is a way to scientifically and methodically approach health where you can, in fact, verify that things are working. You don't have to wait an entire lifetime. You can actually use markers that are well known to predict longevity and health span.
There's been a lot of talk about how this planet is already overpopulated. I mean, with median ages, lifespans of 70 to 80 years old, roughly, depending on where you live in the world. And that's unsustainable right now. If we do get to a point where we are living materially longer into our hundreds and God knows even beyond that here, do you worry at all we might be creating a situation that might be great for us as individual human beings, but collectively as a species could effectively kill us all?
Yeah, I mean, what I've been trying to do is demonstrate a process of maintaining wellness, not just for the body, but for planet Earth. You could easily take my blueprint protocol and apply it to planet Earth. So just like I've become the most measured person in human history, if we were to apply this protocol to Earth, we'd measure Earth with billions of data points every day. We would look at the scientific evidence on what produces a sustainable biosphere, and then we would implement the protocols. So the ironic thing is we treat planet Earth the same way we treat our bodies. We're in the same self-destructive loops. And so what I'm trying to do is say there is a way to methodically approach wellness, not just with our individual bodies and collectively, but also the planet. And so this is the long-term strategy of trying to weave together, like, what do we do as a species in this moment?
Brian, you have a documentary coming out at the start of the new year, Don't Die, The Man Who Wants to Live Forever, and it really chronicles your journey and your self-realizations. Obviously, not everyone can live their life like you. Not everyone can follow blueprints every step. If someone only has the resources, and to do just part of it, maybe we're talking time, maybe we're talking money, what's the single most effective thing that you want them to take away from the documentary?
Yeah, there's no one thing I would say, it's sleep. So I'll give you 5 quick habits. 1 is you're a professional sleeper. 2 is eat your last meal of the day at least 2 hours before bed. Then try 3, 4, 5, 6. I eat my last meal of the day, at 9 hours before bed. Just do 2 or 3 to start with. 3 is be consistent every day within 30 minutes. 4 is have light in your house that is red or amber. Turn off blues and the screens. And 5, have a wind down routine, an hour every night. Read a book, meditate, breath work, but calm your body down so you hit the pillow, you're ready to go to sleep. Sleep is the most powerful drug available to anybody in the world right now. So I'd say sleep as a number 1 life priority.
And this is a question that one of our producers asked about the age of which you start this. Does it matter? I mean, do you need to start it, say, when you're a teenager for this to work? Or if you started in your 40s or 50s, can it still potentially elongate your life?
Yeah, my dad is 71. He's incredibly vibrant. He has turned his life around by doing Blueprint for the past few years. I am so proud of him. His friends are just in awe. So I'd say there's no time that's too late. Also, I'd say for those in their 20s who think this is not the time to start, you should remember that people are starting Don't Die before they're conceived in embryo selection. And so it really is like we are on the cusp of this new wave of anti-aging that is going to be through conception all the way through being a toddler, teenage years. Like it is happening at every stage now. So yes, start right now.
Our thanks once again to Bryan Johnson, the founder and CEO of Blueprint. And, he has a lot of different methods for men, but I think the one I take away from is prioritize your sleep.
You do realize that some of us don't have control over that. But
Yeah,
okay. I'll take that up with my family.
That's part of the New Year's resolution. All right, let's talk about investment in healthcare. It is also the focus of our next up segment, where we highlight the entrepreneurs and trendsetters moving the needle in technology and healthcare and in the VC space. Lushi is one platform looking to transform the $35 billion global fertility market. It offers individuals undergoing IVF with critical tools to better navigate the physical, emotional, and financial burden of the process. Here with more on this is Jessica Schaefer, co-founder and CEO of the company. Jessica, so good to speak with you. Thank you so much.
Thank you.
So just walk us first through the economics of fertility and how much money it can cost people, women usually, and often single women, to make sure that they've frozen their eggs, and if they want to get pregnant, make sure that they have a ready supply of eggs.
Sure. So it's an expensive process. Egg freezing can cost you anywhere from $10,000 to $30,000 per cycle. And if you look at the fertility drugs and the fertility treatment, one follicism unit is 25 times more than Ozempic. So it is pretty costly, and a lot of women are messing it up because it's sort of do it yourself at this point. And so we've created Lushi to really focus on how can we improve the process and leverage technology to create a better experience for women and for men.
What was the aha moment for you that sparked your interest in solving this particular problem in this industry?
So I've always been very ambitious career-wise, and I ended up freezing my eggs after I sold my last company. I messed it up. I took the trigger shot early, which was triggering, and my doctor called me and he told me that I was pregnant, which wouldn't have even been possible. The reality was that I had ovulated, and so what happened was I was supposed to get 30 eggs, but I only received 5. And his response was, oh, you should just do it all over again, as if my body didn't matter and my time. It would sort of be like going to buy a Porsche and it didn't have the tires on it, right? Like, it's a very expensive process, but it has not been invested in historically.
There's also been a lot of criticisms of the overall sort of medical space in the IVF world. The idea that it doesn't always treat its patients like patients, if you will. It's just kind of like you're just basically a human being that they're running through an assembly line. If you get pregnant, great. If you don't, they're on to the next one here. How do you make this more personable, if you will?
Well, to your point, there's a lot of demand. So infertility rates are on the rise. And if you go into the clinic, there's so many people in the waiting room. The doctors, quite frankly, do not have enough time to see everybody and to spend the kind of time that you need to be educated on the process. And so with Lushi, we built an entire platform where you can have remote monitoring. We have one-on-one consultations with our chief medical officer. She's a robotics OBGYN out of Stanford. She's helped solve infertility for some of the top women in Silicon Valley and Silicon Beach. And then we've really invested in the Lushi AI component. And so basically you have 24/7 support where the Lushi responds to your most basically and common asked questions.
Who are you marketing this for? I mean, you talked about your own journey here.
Yeah.
I mean, I guess the perception is that when you walk into one of these IVF clinics, these doctors' offices, it's going to be couples sitting there together in theory. I assume, based on what I've heard from your story, is that there are a lot more single women that also want to partake in this for a variety of reasons. How accommodating is the industry to a single woman coming in to do this versus a couple?
Well, the reality is women work now, right? Which is not a surprise to anyone, but people are having children later, and it is much more difficult. My PR firm was an entirely female-led executive team, and there were a lot of women who would have miscarriages. They were having babies in their 30s, and it just becomes increasingly more difficult. And it's not a topic that people talk about enough, and we're really trying to bring a spotlight on fertility. We launched last week. We had over 300 people sign up in a week, which was incredible, but I think the most surprising thing was the number of men who reached out and talking about their experience with their wives undergoing IVF and how the process was for them. And the reality is, if you do it right the first time and you freeze your eggs between 26 to 32, which is when the quality of the eggs is optimal, versus when you're 35, it's too late, you're under pressure, you shouldn't have to go through this process the way that it is.
All right. Well, this is a fascinating and new product. I mean, and I'm glad you mentioned that. This was just launched this month here after a long career in the world of PR out there in Silicon Valley. Jessica, it's great to meet you. Jessica Schaefer is the CEO and founder of Lushi.
All right, still ahead, we've got what investors need to watch for over the next week. The key data has been reported. We're done on that front in terms of market-moving data, it feels like.
Yeah, I mean, there's going to be a few stragglers next week here, but it'll be interesting to see whether it moves markets or not. We'll be back in a moment. This is The Close on Bloomberg. As we wrap up this week of trading to push ahead to what could move the markets over the next week, and we actually start still in this week, and that is tonight, expecting a vote after 5 p.m. Washington time on a stopgap budget measure in the House of Representatives.
This will be Plan C, and we'll see how far they get. We'll see if it actually happens before midnight, because that's the deadline.
Yeah, and of course, if they don't do it, the government will shut down. We move to Monday, though, and maybe that does affect some of the economic data. We are going to get some consumer confidence data, not official government data, but from the Conference Board.
Yeah, that comes out after the market opens. Then we get the CFIUS deadline reviewing the Nippon U.S. Steel deal, which both the current administration and the incoming administration have said that they are against.
Then on Tuesday, we're going to get U.S. new home sales as well as durable goods here. Potential market moving things, though we should point out that's coming on a shortened trading session there on Christmas Eve.
Yeah, absolutely. So markets will get a couple of hours to react. There's also the release of BOJ minutes after a BOJ meeting in which they decided not to move on interest rates because they want to see what happens with Trump.
On Wednesday, it is Christmas Day, so markets here, of course, are closed. But interesting day for Netflix.
Yeah.
They're doing 2 live NFL games, Chiefs versus the Steelers, and I think it's Beyonce versus the Ravens or something.
Ravens versus Texans.
But you remember the big debacle with the last live event with Paul and Tyson.
Yeah.
So there's a lot of people watching this to see whether they can get it right this time.
Yeah, and I'm sure a lot of people will be on social media if they don't get it right. And then on Thursday, the U.S. market reopens. Jobless claims, that's the weekly data point for Thursday. Although we should mention that the European markets will be closed for Boxing Day. Canada also closed as well.
All right, let's move on here to Friday because we do get some consequential data. Wholesale inventories coming out here in the U.S. You're going to get some interesting data out of Japan with regards to their economic situation. And then South Korea. Remember that alleged coup that almost took place?
Yeah, the 24-hour coup.
So a preliminary impeachment hearing on the South Korean president. We'll get you an update on that. Please stick around, though. Balance of Power coming up next. They're going to have full coverage of everything going on in Washington and that budget battle. That's coming up next, right here on Bloomberg.